If we don't prepare for the next downturn, we'll only have ourselves to blame. Now, I've been trying to nudge people into preparedness for a while now. No one knows when, why, how, or how long a downturn will last, but bear markets have not been eradicated, and recency bias has made a lot of people complacent. Many have lost perspective about what they can and cannot tolerate simply because they haven't been tested in a long while. Let's just agree on this. Most portfolios today are not optimized. They're stuffed with too much risk and padded with assets that are, let's be blunt, overvalued and expensive. That's fine when markets only go up. Several core metrics suggest equities are priced well above historical norms. The Shiller-Cape ratio for the S&P 500 is hovering over 40, more than double its long-term average of 17. Such levels have often preceded weak returns. The Buffett indicator, at roughly 220% of gross domestic product, also flags stocks far more expensive than the economy beneath them. Anecdotal information is sending us warning signals, evidence of heavy retail participation in the stock market, elevated meme stocks, and the recent sell-off in crypto assets should have alarm bells ringing. But at a minimum, these developments likely demonstrate genuine fragility. My own view is that what is keeping investors investing using standard asset allocations isn't a lack of risk awareness, it's paralysis. If standard portfolio prescriptions are risky, what should rational people do instead? Go to cash? Rebalance? Let it ride? The truth is, nobody knows how long this bull market and everything bubble will last, or what will end it. What I do know is this: when the turn comes, there will be no one to blame for a lack of preparedness but ourselves. I've been personally concerned about these metrics since just before COVID hit. Candidly, I'm a bit gobsmacked that valuations have remained this stretched for this long. I'm not alone, however. Plenty of smart people have been warning us to proactively reduce our risk exposure. Fundamentals still matter, even if technical factors drown them out for a while. And right now, the technicals are winning. Record index levels, mega cap concentration, a chase for yield, and price momentum that is feeding optimism. I remain especially concerned about optimism bias, the sense that bad things won't happen to me, coming from people who are sensible enough to acknowledge that bad things do in fact happen. And against that backdrop, we've all been told that staying invested is the only way. Really? I tried to gently nudge people away from this mindset in my 2023 book, Bullshift: How Optimism Bias Threatens Your Finances. The largest asset management institutions of the world love the mantras I talked about above. It keeps your money in their products and their fees flowing. They repeat them with near religious fervor. It's convenient, isn't it? But consensus, as stated by a multi-billion-dollar industry that has skin in the game, can be dangerous. My point here isn't about market timing. No one can time markets reliably. Rather, all I'm saying is that you need to reposition towards safety before the market does a rebalancing on your behalf. People should proceed with carefully chosen assets. Here's what that looks like in practice. 1. Add defense. Staying invested doesn't mean staying unprotected. Mix in stability with reasonably valued stocks, low volatility investment options like core infrastructure, or a transparent mortgage offering. 2. Favor safety. When valuations stretch, margin of safety matters. Look for a proven downside capture ratio so that the products you own fall less when markets drop. 3. Don't just chase bull market heroes. Look for products that protect capital through downturns. Monthly returns, always after fees, versus benchmarks can tell a true story. 4. Consider using smart beta. You don't need the whole index just because that's what everyone else owns. There are smarter substitutes with built-in defensive tilts. 5. Be intentional with illiquidity. If you've got conviction in private assets, as I do, great, but balance that conviction with liquidity. With valuation stretched, flexibility will be key. And allow me to repeat this. This isn't about knowing exactly when the party ends. It's about not being left holding the bag when it ends. I'm more convinced than ever that early 2026 will ultimately go down as the last chance we all had to take risk off the table to more accurately reflect our true risk capacity and risk tolerance. Don't squander this opportunity.